So Tyler, we're well into January. Plenty of investors out there are looking to supercharge their investing. The market's gone up so much the past couple of years. A lot of stuff's really expensive, but as always, there's always something that's worth buying. And if you look past concerns about the near term and think long term, we know the stock market has proven to be an amazing way for just regular people to create long term wealth. We're going to do something a little different. We're going to talk about 3 stocks that investors should be thinking about buying to kick off 2025. You ready?
Well, you were just so full of ideas this year that we had to give you 2 this time around.
It goes to 11. I just hope
All
somebody
the
got that
stock
reference
ideas go to
besides me and
11.
you. That's all. All right, Tyler, let's get to it. But first, this is Investing Unscripted. This video is sponsored by The Motley Fool. We got 3 great stock ideas that we're going to talk about on this video and get access to 10 more. Go to our special link. It's fool.com/unscripted. Go to fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. Go check that link out. Okay, Tyler. So here's how I want to do this. So we've got a company that you've talked about before on the channel, but it's still, I think, really underappreciated and easy to overlook because the market that it operates in, but it's established, it's growing very quickly, it's profitable. It's a business that you own and actually have added more to your portfolio recently. We'll talk about that stock. And we've got something that's a little more on the risk side we'll talk about. And then we've got a stock for investors that maybe are concerned about the market being overly valued, concerns about maybe not getting great returns for some of these higher growth businesses. It's a good stability investment with a really high yield right now and a dividend that's very, very secure. You ready to kick us off?
Like you said, I've talked about this one before. I'm probably going to keep talking about it for a while. This is BBB Foods. The ticker is TBBB. This is a hard discount grocery retailer in Mexico. It has about 2,600 stores today. It's a very unique footprint. Hard discount basically means like no frills. The stock tends to be on pallets on the floor rather than on shelves. Very no frills. If you've ever visited something like a grocery outlet bargain market is the United States version
There
of
you
it.
go.
So
There
kind
you
of
go.
all the same idea, but they've taken the same concept, goes in Mexico. A little bit more tailored for the Mexican customer. In previous videos, we've talked about like kind of the details that the company has gone into when it comes to knowing its customer demographic and selling specifically to it. And it's a thing that has worked. It's a company that for a decade has had double-digit same-store sales growth on top of store count growth. And we were talking about stuff being expensive right now, and on paper, this one looks quite expensive. I'm typically the more value-oriented person here, but I'm pitching a stock that has a PE of 250 times, which doesn't sound right. But the concept being here is that low margin groceries, when you have very, very low earnings, you gain a couple of percentage points on your net income. That can change pretty drastically. And so the kind of the long-term thesis here is that even though it has about a 2,600 store count, management believes that a fully built out about 20,000 store footprint. So we're looking at an almost 10x growth in the store footprint on top of same store sale growth and comps and things like that, which for over a relatively long term, I think it looks quite attractive. And that's why I'm very much willing to overlook what is seemingly a very expensive stock.
So it's actually closer to 300 times where the market closed with the stock more recently. But and this is typical of companies that are still early in their growth phase where their capital deployments and things are increasing some of their non-cash expenses. If you actually look at its price to operating cash flow, it starts to get a little bit more compelling. So using that in context with like the earnings multiples can help. This is also a recent IPO. The stock has gone up almost 60% since it IPO'd in early 2024. So it's not even a year as a public company. So I think there is a lot to like. The one last thing I want to say, thinking about these sorts of businesses, when they grow, they also start to get more operating leverage because you get more locations within its distribution network. So all of a sudden it gets a little bit incrementally lower cost to distribute goods to stores and you gain efficiencies, and every dollar of revenue is worth more on the bottom line than the first dollars of revenue were. So there's a lot to like here. You ready to get risky, Tyler?
If there's somebody that's going to do risk, it's going to be you, Jason.
Fair enough. All right. I am going to do risk. I'm going to talk about Upstart. So it has been a wild ride for Upstart investors since the company's IPO. Give me just a second. I'm going to pull this up on the screen. And as you see, this stock climbed Mount Everest and then leapt from the top of it in late 2021, along with a lot of other tech stocks and SaaS stocks and work from home stocks and renewable energy stocks and housing stocks and all kinds of stuff from this peak, this bubble period. The stock crashed. Now, another thing that happened that this trough that we saw right here, when interest rates skyrocketed, Tyler, it really upended Upstart's business. As Upstart's business is the platform to use artificial intelligence to identify risk for primarily personal loans, but also auto loans. They're stepping into home lending. And the idea is that FICO, Fair Isaac kind of has this stranglehold on the credit market for individuals. And Upstart's contention is that there are a lot of people that are much lower risk than FICO says, and also some people that FICO says are safe that are probably riskier borrowers, and their AI is better able to identify more accurately with risk. They do issue and hold some loans, mostly for testing for products, but primarily the goal is the platform exists for its partners to use, largely credit unions and banks, to identify credit-worthy individuals for personal loans and other products. And with interest rates skyrocketed, Tyler, its business was upended. They had invested a lot on growth, hired a lot of people. They ended up cutting their headcount, I believe 20% or more from the peak, to kind of right size the business based on where things are. And it's been pretty tough over the past couple of years, because when interest rates went up, all of the lenders that were doing personal loans pulled back, because this is some of the riskiest kind of lending. The only thing that secures it is somebody's credit score. Yeah, and there are ways in different states that they can go and get judgments to get some money, but it's expensive, it's hard, and usually the lender's going to sell it to a collector before they try to do those things, often at pennies on the dollar. So lenders have pulled back from that kind of risk, but at the same time, more and more lenders keep signing up with Upstart as partners, and it's positioned Upstart. So as we've started to see like the faucet get opened up a little bit and still just a trickle, their business is back in growing mode. They're adding more loans, or more loans are being originated on their platform through their partners. Those are positive signs. So we're starting to see some indication that the growth is coming back. And the key is the product has to work. Lenders are not going to sign up for it. Banks, credit unions in particular, are very risk averse businesses. They have to be, because they're extremely leveraged. Their margins are actually pretty thin, and they make their money on the back of somebody else's money, right? Their depositors' cash that they collect, they have to give those deposits back whenever the depositor comes in and asks for it. So they have to be really, really risk averse when it comes to that. So making a switch from the primary way that lenders have identified risk for decades is not a small task. So seeing them begin testing it and begin using it is compelling. So why now? I think that the valuation, the market cap of the companies around between $5 and $6 billion, has gotten to where the risk reward, that tension, is getting interesting again and compelling for investors who buy, where there's still plenty of upside. Because if this business does become established and we see more and more lenders use the platform to originate loans, this could be a $50 billion business in a decade. So there's a tremendous amount of potential upside for investors here, but there's still risk. This is why I think that investors should still kind of tread lightly here, is that we haven't gone through like an actual recession. The pandemic recession was caused by the pandemic, not by a weak economy. We haven't gone through an economic period where people are having to make the hard decisions. It's like, okay, do I pay rent? Do I pay the car payment? Or do I pay the credit card and the personal loan? The credit card and the personal loan are the things that people pay late or skip first. We haven't gone through one of those environments. So we're yet to really find out, in a hard economic environment, the quality of their assessment of people's risk. That's why I think investors should tread lightly with Upstart, but I do think it's interesting right here. Okay, I know investors out there watching me and you aren't always looking to lean into risk or cross the border to buy an obscure Mexican grocer. They might just want something stable and secure. Let's talk about Realty Income, ticker O, and why Realty Income looks appealing right now for investors over the long term.
Well, it certainly is one of the more boring versions of things that we have here, but which, hey, I am never one to blame boring on something that makes money, and that's something that Realty Income has done in spades for a long, long time. It's pretty easy business to understand. They own property and lease it out. It's a net lease property, which means it typically leases out standalone properties, the tire change shop in the front of a strip mall or things like that, single tenant operating facilities, anything like that tends to be, I like to think of it this way. Any single building in this style of like leasing is actually quite risky, because it's binary. It's either leased or it isn't. So you're either making money or you're not. But if you spread it over a very, very large portfolio of assets, it becomes the risk becomes quite low, because if you have 10,000 properties and 5 of them aren't leased up, then it's not really a problem, right?
And it becomes even lower risk when you partner with investment grade, really high quality customers like
McDonald's,
Costco, other big box
Home
retailers.
Depot.
Experiential has become a bigger part of their base. They are one of the owners of the real estate that the Bellagio sits on. You have really high quality tenants and you own all or a majority of their real estate, it does become safer. And the other thing you mentioned, the triple net, the net lease model that they have, you still have some risk, but your tenant, that means that the tenant pays you rent, but they also pay the property taxes. They're also responsible for maintaining and improving the physical real estate that's sitting on the property as well. They take on all of that risk. You have to finance and own the land itself, and you take on the risk of a location closing and losing rents and that sort of thing. But it does create this incredibly stable business in terms of the cash flows and their ability to pass a share of those cash flows back to you as a REIT via dividends.
Yeah, and it's something they've done for decades now. I think I'm going to get the number wrong, but I think it's like 270 something consecutive quarters of increased payments. I think
It's
it's
every
something like
single
that.
quarter since the company went public in 1994.
Yeah,
They've raised the
so
dividend every quarter, not just every year,
yeah,
every single quarter for that
to be
period of
granted,
time.
sometimes it's like fractions of a penny, but it has done it, and it's one of those like commitments to that it has made to its investors. I've poo-pooed investing in realty income from time to time, but mostly I've done so when it's related to valuation more than anything else.
Right.
When you have a business like this, you do have to be a little valuation sensitive because you're buying realty income at I don't know, 1.5 to 2% yield doesn't make much sense because it is a relatively slow grower.
Right.
But, at today's yields of, I think it's north of 5% today, that makes much
Oh,
more sense.
it's even better. How does 5.97%, knocking on 6%? That's
Much better.
compelling. You look at over the past decade. I mean, we can go back to 2010, and that is consistently on the very higher end of where its dividend yield has been. And you see on here too the dividend growth. There was a while, Tyler, you see back in the late 90s, early 2000s. Now these spikes, they were paying special dividends. That's what these big spikes were. But here, they were growing the dividend every month. Every month, Tyler. The increases have gotten smaller, but they've still been pretty consistent with growing that payout every year, every quarter, capturing that higher dividend yield. So I think you're spot on. This is, if you're going to overpay for a company and still profit as an investor and potentially outperform the market, it's when you're buying the upstart disruptor, still early in its phase company that still has a relatively small market cap, but a really big addressable market where they can really grow their earnings and cash flows per share over the long term. Your kind of your margin there is in their ability to grow into the valuation. If you're buying a realty income, this is one of the biggest REITs in the world. You've got to pay a good price. You've got to get a good valuation, and you get a good valuation right now. Investors that are thinking more about having a high floor where you're not looking necessarily for the ceiling, right? You're not looking to blow it out of the water, but you want something that's going to give you a predictable long-term return and generate good income, starting now. Realty income, you're going to get a dividend every month, nearly 6% yield at these prices, small little increase on an annualized basis. And the stock will be volatile, of course. I mean, it's down about 10% over the past year. But if you're looking to pay a good price today for something you can hold for the long term and give you some good ballast and income in your portfolio, yeah, I think you're right. I think now realty income from a valuation perspective looks attractive now.